Which one of these is a real winner? In both cases, the RSI dipped below 30 line, which is a default oversold level, signaling long entries. However, on the trade 2, the RSI is slightly more oversold but same long entry setup. Now watch closely. If you play both trades, the trade on the left end up hitting stop loss, but the one on the right, it reaches to the profit target. Same situation but different results. Why? After backtesting many pairs and different time frames, I figured out the overbought and oversold levels are not the right entry points. In fact, they act more like a retail traps. To use RSI in a profitable way, it has to go through entry criteria instead of overbought and oversold level, and that can be applied to any pair using only 4 simple steps. The first step is the one by far the most important and yet also the most overlooked. There is no such thing as overbought and oversold zones in trading. In fact, when you see RSI is pushed above 70, it is usually a sign of strong bullish momentum, and when you see it is dropped below 30, that means a heavy bearish momentum. That is the reason why on this chart, when RSI pushed above 70, the price kept on making higher highs, reflecting a strong buyer's volume. And based on the same concept, when RSI dipped below 30, the price kept on falling and it is not bouncing back. Therefore, it is clear that traditional overbought and oversold levels are misunderstood traps that deceives many traders into making poor decisions and pushing the traders to enter premature positions. But this middle 50 line on RSI is the significant one, and we will cover this later in this video. Which brings us to the next important concept. For RSI, the price has to move first. And this is where the problem lies. What if I told you these 14 candles will push the RSI above 70 and the very next 14 candles can actually drop RSI below 30? That is because the RSI is based on a mathematical calculations of 14 candles. Because of that, if we enable RSI and analyze, the price was already overbought at this point. Interestingly, based on the next 14 candles, it went further above the 70. That's because the average percentage and size of green candles is more than red ones. Now the situation gets even more interesting on the next 14 candles, which end up dropping the RSI below 30 because of having more red candles and bigger sizes than the green ones. That means the range of relative strength can be based on any number of candles. For example, if you change it to 24, the RSI will change its result as well. Hence, no indicator can predict the market. RSI is a lagging indicator. It never gets information from a broker or any trading server. Rather, it calculates the recent 14 candles. So based on the backtesting using default 14 candles, the bearish setups are normally found between 40 to 80 and the bullish ones from 60 to 20. To identify these setups correctly, we need a method. This is where the step 2 of divergences comes in. Divergence occur when the RSI trend moves into opposite direction to the price trend, just like this one on the chart. This divergence is called bearish divergence. In this case, the price is making higher highs, whereas the RSI is turning into lower high, because of which the price pulls back. Notice around the highest price points, the price kept on pulling back. This is a downtrend. Therefore, it is called bullish divergence. Notice how price is making lower lows, whereas RSI is making higher low. As a result, the price pulled back. Many traders mistake RSI's divergence as a signal for a trend reversal, but that is not accurate. Reversals indicate a long-term trend shift, which RSI alone can't confirm unless it is a key level or a fundamental factor, and we're gonna cover that in this video. Now to the next type. On this chart, the swings on the price as well as on RSI are far away from each other. That is why it is called wide divergence. You can only spot difference on RSI when you draw a trend line on both swings. In any case, it is not necessary that RSI must remain above the 70 to form a wide divergence. You can see around this point, the RSI was below 70, but the price made higher high and then it pulled back. Close swings. These type of swings are not easy to spot. because the close swings occur within 7 candles. Over here the price is slightly fluctuated, but on the RSI there is a divergence and therefore the price pull back. To spot these small tiny divergences, you can actually use a simple tip, that is to turn your chart to line chart. If you switch to line chart, you will easily spot this divergence. But with the divergence there is one big problem. Over here we have a clear divergence, that means a pullback. But instead of that, the price end up going long. That is because of not having confluence. One of the most important confluence which is often ignored by many is a fundamental factor. Let me show you what I mean. Over here the price is climbing higher and higher, but the RSI is doing the opposite. This is what we call bearish divergence. In this case, the price should pull back, but instead of that, it end up going long. On both occasions, it turned out to be false. In fact, RSI is going down while the price is touching new highs. That's because of fundamental changes. One of the most impactful factors is central bank policies, especially changes to the interest rates. It can shake up currency values in a big way. Have a look at this chart. On 18 September, the Federal Reserve announced an interest rate cut. What happened next? The gold price skyrocketed. The RSI was already above 70. Yet instead of pullback, the price kept on climbing. That is why relying on RSI's overbought and oversold level is disastrous, because the fundamentals can push the RSI above 70 or below 30 multiple times. That is where the need of spotting key levels comes in, hinting price reversal. Here is what I mean. On this chart around these 2 points, RSI is showing divergence. Traditionally, this is not a valid divergence, but in spite of that, the price reversed. That is because of key levels. Here is another example which doesn't follow traditional overbought scenario. Clearly, the price went up, created a close divergence, and then reversed. That is why it is not necessary that a divergence must occur above 70 or below 30. On this chart, the RSI shows divergence but doesn't fully drop below the 30 level. Yet the price is still reversed. That is because the key level acting as a decisive factor. But instead of entering on RSI signal, we're gonna be using a confluence, that is to draw a trend line. And this will be the entry point. The trend line is another confluence of reversal. Not only that, the candle which broke through the trend line closed with the body, signaling positive entry. This leads us to support and resistance zones as key levels. Over here on this chart, the price is going up, creating the highest point. After that, price reverses. Therefore, we mark this resistance area. Then price goes back to same resistance area, which actually means an early sign of a possible reversal. On top of that, we spot a clear divergence, but we don't enter trade. Remember, we use trend line as an entry confluence, and as soon as the candle crosses through this trend line and close in a decent body size, we call this as a trading opportunity, because right now we are following a step-by-step entry criteria instead of just following divergences. That leads us to the next example. Here the price is dropping down and creating lower low, but on the left side it is reaching to a key support level. At the same time, RSI is showing us a bullish divergence, and remember, we add a trend line to confirm our entries, because the trend line works like a second opinion before making any move. So pairing RSI with key levels can be a game changer for trade entries. But if you're aiming for trades with high win ratio, it is time to use advanced techniques like drill down and hidden divergence. Watch this. Over here the price is testing recent support level. If you pay close attention, it's a daily chart. Notice how there is no divergence on RSI. Here is where the real magic happens. We're gonna drill down to 4-hour chart. Do you see anything? Now there is a clear divergence on RSI. And not only that, it also confirms the trend, which then allows you to enter a trade at a refined level, offering you a precise entry. In essence, drill down technique involves checking to see support and resistance on higher time frame. Once confirmed, then drill down to lower time frame to identify and refine your entry using RSI divergence and trend line. Now to hidden divergence. This is a clear uptrend. Pay attention to these swing points and their corresponding levels on RSI. The price is moving up in waves. went up, pulled back, went up, and so on. But before shooting up, notice how it broke through the resistance. Before making that move, it essentially formed a hidden divergence. So when the price is making higher lows, but RSI is making lower low, that's the hidden bullish divergence. Now to the downtrend. Take a look at these points on the chart and find out which points are signaling hidden bearish divergence on RSI. It is these 2 points. Essentially, they are forming hidden divergence. So we mark this on the chart. But if you think identifying these divergences is a difficult job, then remember this. On RSI, 70 and 30 levels are not significant one on its own. However, this middle 50 line is the key to a profitable strategy. For this, go to RSI settings and under the input tab, make sure to apply these settings on your chart. Next step is to use 4 hours chart because we need to make sure that we are picking a trending pair for the intraday trading. I picked GBP JPY. For entry purpose, make sure to switch your chart to 1 hour. Over here the RSI has crossed this 70 level. Now you need to wait for the RSI to drop below or around 50 level. Over here RSI has crossed the yellow SMA line from below around 50 level. This is a golden cross to enter long. So if you had entered long here, this is how it would play out. Now to the next example. As you can see here, RSI did not go above the 70 level, which is not necessary. However, it dipped below 50 level and crossed SMA around 50 level. So we entered long here. Now to the downtrend. Select 4 hour chart and find clear downward trend. Once confirmed, switch to 1 hour chart for the entry. Here RSI dipped below 20. So we're gonna wait for it to go above the 50 level. Once it has crossed SMA from above, this will be the short entry signal. However, if you're constantly losing money while trading, then watch this video to solve it.